Kumar.
Good morning, Fiona.
Hi, is it nice and sunny over there today?
Yes, it's a lovely day for us here. Yes.
We haven't got the sun today, but hopefully it'll be back soon.
All right. Okay. Our temperature is about 20 or something, 24, 25.
Oh, okay.
Nice and hot.
Yes.
Yeah. Right. Good. Great. Right. Yeah. Did you manage to get to the recording? I sent you another link today.
Yes, I had a quick check and that one seems to be working fine.
Okay, fine. Right. Okay. Because actually,
Thank you.
yeah, I was trying to make a different one, but it's all right. So long as it's working, it's all right. No problem.
Yeah, okay.
Right. So let's continue with our consolidation, what we started yesterday. So you remember I told you one of the important days what you have to remember always is the date of acquisition. Date of acquisition.
Yes.
Today we are going to learn the date of acquisition is the date where you get your control. Because sometimes it may happen that today we take, say, shall we say in a company we take 20% interest, then we don't control.
Yeah.
But we take another 35% later, what we call a piecemeal acquisition. And when we get that 35%, 20 plus 35, 55, that day we get the control.
Yes, yeah, and that quite often comes up in questions, doesn't it?
It always comes up because that's what we call a piecemeal acquisition. And what we have to remember is the very first day 20% is not so relevant. The relevant date is when you get the 35%, when you are able to control the company, that's the day that you start consolidating the account.
Yeah.
So that's something what we're going to learn today, Julie. And so date of acquisition is that. Now the date of acquisition, we have to find what is the percentage holder of equity. So in the case what I said, 55% we are holding. That means the balance 45% is held by outsiders whom we call non-controlling interest. And on that day, we have to look at, yesterday we were discussing this matter, on the date of acquisition, what is the net asset value of the subsidiary? What is net asset? The subsidiary share capital, subsidiary retained earnings, subsidiary any other reserves, all those added together is what we call the net assets. But today we are going to include another new term, fair value adjustment. Now, what we see in the statement of financial position, you remember we discussed this one a couple of days back, non-current assets, current assets. The non-current assets appear most of the time at cost minus accumulated depreciation or revalued figure minus accumulated depreciation. Now, not necessarily that is the fair value on the day of the transaction, right? Because that's another accounting convention we use. We go on depreciating all that. So, for example, you buy a vehicle for $10,000 and after 3 years, the vehicle appears in your statement of financial position, cost minus accumulated depreciation at $2,500. But if you want to sell the vehicle, you will not sell it at that price. You will look at the market price. So, similarly, whenever we want to acquire a company, that particular company shareholders are not going to give the valuation of the company just because the assets are appearing at cost minus accumulated depreciation. That's not the fair value. They will say, look here, the fair value is 100,000 more. Fair value is 200,000 more. So your net assets, which is appearing at, shall we say, 400,000, need to be increased by that increase, the fair value adjustment, and that fair value adjustment may be, say, shall we say, another 75,000. So 400 plus 75,000, 475 is the fair, the net asset fair value. And often it happens mostly in non-current assets. Why? Because the current assets generally it is at fair value all the time. What are the current assets, Fiona? Inventory, receivables, cash in hand. Correct?
Yes.
They are the current assets. They appear generally normally at fair values. I mean, they are almost closer to the realizable value. But the non-current assets, we go on depreciating, and therefore they may not reflect the true fair value. So examiner might say land and buildings which is appearing in the balance sheet as 100,000 need to the fair value is 125,000. Or they might say excess of the value of the book value to bring it to the fair value should be another 20,000. So you have to look at what the examiner is telling and pick the excess exactly in the same way. But this work in what we are going to do is only for purposes of consolidation. You are not going to adjust the subsidiary books. You are not going to bring that 20,000 back to the subsidiary books. Remember I told you, subsidiary prepares its own financial statement. Parent prepares its own financial statement. Parent, in addition to that, IFRS 10 says they must prepare consolidated statements. Consolidated statements are prepared from...
Sorry.
No, it's okay.
Yeah.
Right. Consolidated statements are prepared always from the working papers. They don't have a separate ledgers and all that kind of a thing. You just bring the two sets of books and you try to prepare a consolidated statement. Now today we have the computers knows what to do. They have programs, so you can just put the two sets of balance sheets and it will prepare the consolidated. But for our calculations, we have to do the normal manual way. So the goodwill is always at the acquisition only. As I said, we have a goodwill. It is calculated adding the consideration what we have to pay. So let us look at some figures. Let's assume that we are going to pay a consideration to buy a particular company called P. So A is our parent company, B is the net assets on the net assets. Let's assume that it is going to be 75,000. And maybe there's another fair value adjustment of 5,000. So total fair value of the assets is 80,000. Let's assume we are going to take 70% of this company. And the consideration we are going to pay, consideration is what we have to pay to buy those shares, is let's assume we are going to pay 125,000. So that is what we call consideration. 125,000 we are paying as a consideration. And how to calculate the goodwill? To this consideration, we must add the NCI, non-controlling interest value, on the day of the acquisition. So there are two ways of non-controlling interest. One is what we call the proportion method. The other one is what we call the fair value method. So let's assume whatever the method, that non-controlling interest of this particular company, let's assume it is 30,000. Consideration plus non-controlling interest, the balance of 30% is worth 30,000. What is the total figure? 155,000. Compare this with your total net assets. Remember, total net assets, the fair value of total net assets, which is 80,000. And the difference what we have paid is what we call the goodwill. So it's always the consideration plus the non-controlling interest value on the day of acquisition minus the total net assets of the company adjusted for the fair value is the goodwill. So very simple, if you can remember that one. Consideration plus the NCI minus the total net assets value adjusted for the fair value, that is what we call the goodwill.
Yeah.
Right. Then after that, you remember we discussed in IAS 36 that goodwill, what we have brought into existence, we must all the time check for any impairment. Why do we pay something for a goodwill? Because the company has some good name, reputation, something. So because of that, we pay something extra to buy that company over. And after that, every year, we have to check for any impairment. After we buy, the goodwill can go up, but we can't recognize that part of it. We can recognize only losses or impairment. So according to IAS 36, what we learned, we will look for goodwill impairment. And if there is a goodwill impairment, so now for example, in this particular case, I think the goodwill came to something like 75,000 or something like that. Next year, the directors will try to get a professional opinion of the goodwill. If it says 70,000, 5,000 must be written off immediately to the P&L of the consolidation. Remember, to the P&L of the consolidation. Yeah. The parent company is not affected, subsidiary is not affected, but the 5,000 need to be written off to the P&L of the consolidation. But if the professional valuer says no, goodwill is 80,000, keep it at 75,000. You can't increase it, yeah, but you can go on reducing it. So then we have to look at the date of reporting. So as I said, maybe we took the control on January 14, but we are now on 31st December 2016. So at the time of 31st December 2016, we have to see that's the day we are going to prepare the consolidated statements. Obviously, after we take over the company, every financial year in, we will be preparing the consolidated statements. So there we have to calculate to find out the net asset increase of the subsidiary. Now you remember that we bought that subsidiary when the net assets had a value of 75,000.
Yeah.
75,000. Of course, we increased it by 5,000. Now I like to look at it, but remember in the subsidiary books only the 75 will appear. Even though we manually calculated the 5,000, it is not there in the subsidiary book. So after 2 years, when you are preparing, you might find the net assets of 75 going up to 90. Now the moment it goes to 90, that means there's a 15,000 increase or a 15 million increase in the net assets. And how come that happened? That happened after we took over the company. With our control, the company has increased the net assets. How can the company increase the net assets? By having profits. So this 15 million, we call it post-acquisition profits. Post-acquisition profits. Since the day we acquire, we have got 15 million profit. But we have a little adjustment to do. What is that little adjustment? Complicated, famous, always coming up adjustment. You remember that we increased at the time when we were buying the asset, the non-current assets may be by 5 million. Non-current assets. Now, non-current assets at the moment, whatever the figure in that 75 million, there will be a part non-current assets, part current assets. The non-current assets, that part which is there at 75 million, they will depreciate it, correct? Yeah. The subsidiary company will depreciate and it will appear in the subsidiary company's P&L, all that. So no problem about that one. But that 5 million which we included, that 5 million is not getting depreciated. Because the subsidiary finance manager has nothing to do with that 5 million. That is something which you included for purposes of consolidation. Now that 5 million also need to get depreciated. So the examiner will tell that the fair value what we adjusted for the buildings will last another 5 years, for example. or will last for another 10 years, for example. So because of that, this 5 million what we brought as an addition need to get depreciated. So although we have made a 15 million post-acquisition profit, this 5 million also need to get split over 5 years. So every 1 year from the post-acquisition, we need to write off another extra 1 million. That is what we call excess depreciation on fair value adjustment. So this is my first adjustment I'm teaching you on the post-acquisition profit. There are 3 adjustments on post-acquisition profits we are going to learn. But the first adjustment I'm teaching you just now is the change due to the change of fair value. So the fair value got changed by 5 million. We increased the asset value by 5 million. It is not depreciated by the subsidiary company. And therefore, when we are preparing consolidated accounts, we need to adjust it. So I said it was bought on 1st January 2014. So 1st January 2014, 1st January 2015, 1st January 2016, 3 years have gone by. So that 5 million, every year 1 million, 1 million, 1 million. So for 3 years, we had to reduce this post-acquisition profit by 3 million. So this is the first adjustment we do before we calculate the post-acquisition profits for the purpose of taking part to us, part to the non-controlling interest. We must do this first adjustment for the fair value adjustment excess depreciation. Now here again, you have to be very careful. Sometimes the examiner might tell that ACC examiner is very famous for this again. He might tell, the excess depreciation came on land. Now, if it is land, no
land, sorry, yeah.
If it is land, then that 3 million adjustment will not come because the land is not depreciated, right? So land, in that case, no problem. But if it is buildings or plant or something like that, then excess depreciation will come. So I remember a couple of years back, there was a ACCA question where the examiner said land. And he just went on to explain, and the students went on starting depreciating, which is crazy. So that is the thing. So that's what we have to look at. So first we look at the net assets on the date of acquisition. Secondly, we look at the date on the reporting date. That entire increase is post-acquisition profits. But the post-acquisition profits are one adjustment. What we are going to look at is for these, what we call for excess depreciation. Then, so I said post-acquisition profit should be adjusted. Number one, we just talked, the first one I spoke was about any excess depreciation on fair value adjustment. So there are 3 adjustments. We just learned any excess depreciation on fair value adjustment. Then any goodwill impairment. The company has made a profit of 15 million. You might find the goodwill that was considered 75 million at the time of acquisition is now dropped by 2 million. So our post-acquisition profit, how much? 15 million. 3 million, we are going to reduce it for the fair value adjustment. And the second adjustment is for goodwill impairment. Goodwill impairment. So the goodwill, you might say, the goodwill which was 75 has come down to 70. So adjust for another 5 million. 5 million. So that's the second adjustment. Then URP. What is URP? URP is unrealized profit. Now the parent may sell goods to the subsidiary. Subsidiary may sell goods to the parent at a profit. It's a perfect legal transaction. You are the parent and you are sending me some goods, you are making a profit. So in your parent company P&L, you will have a profit, right? You will have a profit. And because it's two separate legal entities, it's perfect all right to make a profit. You have to pay taxes on your profit. I can treat it as an expenditure, it's all right. But when you are preparing consolidated statements, any unrealized profit need to be completely eliminated. Now, where can be the unrealized profit, Fiona? Where can be the unrealized profit? How come you are selling to me and, let's assume that you are a parent, you are selling some goods to me. I also sell those goods to outsiders at a profit. You sell it to me at a profit, I sell it at a profit. Right? If all the goods what you sold to me, if I have sold it to the outsiders, then there is no question, everything is realized profit. Right? Everything is realized.
So it's just if you...
Yeah. In that case, you just ignore. But you have sold me goods. You have sold goods worth to me worth $100,000, and on that you have made a profit of 20,000, which are very happily showing in your P&L. But all the good, out of the goods what you have sold to me, I have sold only 50% to the outsiders. In that case, even though in your own accounts you can take for the whole credit of 20,000, when we are preparing consolidation, we have to understand only 50% of that 20,000 is realized.
Yeah.
So for that,
and this comes up a lot as well, doesn't it?
It always comes. It always comes.
Yeah.
It always comes. It always comes. The examiner might say parent is selling to the subsidiary or subsidiary is selling to the parent. So I'm just looking at the example just now with you. A parent selling to the subsidiary. Parent says, and he has made a 20,000 profit, but 50% of the goods are not yet sold by the subsidiary. In that case, a 10,000 provision should be made, because when you consolidate, what happens is the subsidiary will show inventory at a higher price, including that unrealized profit. So we are going to add both the inventory. So we are going to inflate the inventory by that 10,000. So we have to remove 10,000 from the inventory and remove 10,000 from the parent company's profit and loss. Because the whole 20,000 is shown in the parent company P&L, which we will consolidate. So we have to remove 10,000 from the parent company's profit and loss. One thing. But that's not, for that we don't need to adjust the subsidiary profit, because the subsidiary did not turn. Now look at the opposite side. I'm the subsidiary. I'm selling you goods worth 100,000, and I have sold goods to you. You have not yet sold the entire goods. 50% of the goods which I sold remains unsold in your books. Right? In that case, the subsidiary has made a profit of 20,000 by selling goods to the parent. And that 20,000, only 50% is realized by the parent. So when we are preparing consolidation, subsidiary profits are overstated by 10,000. So that post-acquisition profit need to be adjusted by that 10,000. That is only when subsidiary sell goods to the parent. Subsidiary sells, the parent sells goods to the subsidiary, adjustment is in the parent companies, and that is not going to affect your post-acquisition profit. So you have to be very carefully read the question to find out who is selling to whom. If the parent sells to subsidiary, no adjustment necessary in the post-acquisition profit. Adjustment is necessary in the parent company profit. But if the subsidiary sells to the parent, then adjustment is necessary in the subsidiary profit. So 3 adjustments we had spoken: goodwill impairment, excess depreciation over fair value adjustment, subsidiary selling goods to parent, we have to adjust it. So this adjustment is compulsory. This adjustment gets compulsory when the subsidiary has sold goods to parent. This one, goodwill impairment, in a minute we will learn another little trick. It is there, but whether it is going to be, whether we have to deduct it from the subsidiary or not, In a minute, we will learn that one.
Okay.
So after these adjustments, yesterday we remember you are very generous, but I told don't be generous. The profit that is coming on, only the subsidiary profit after those pre-adjustments, right? After the adjustment for goodwill impairment, after the adjustment for subsidiary selling to the parent, after the adjustment for the excess depreciation, that subsidiary profit you will split it between parent and the subsidiary according to your share, but don't split the parent company profit. Now NCI on the reporting date will be the total NCI on the date of acquisition. So when we acquire, there is an NCI value plus any post-acquisition profits after those two adjustments. If the NCI is 40%, 40% after the adjustments, that profit will be given to the NCI. Then consolidated retained earnings, as I said, it is the parent company retained earnings plus the post-acquisition profits after those pre-adjustments. For the pre-adjustments, our share, the parent company share will be our thing. So total parent company retained profits and parent adjusted profits acquisition less any URP if parent has sold goods to subsidiary, that is what we learned. Now I'm going to this next thing. So by definition, a subsidiary is an entity that is controlled by another entity, parent. Control is normally achieved by taking more than 50% of voting shares. Balance part is owned by, not owned by the parent, is called the non-controlling interest. So most of the time in our questions, we have a non-controlling interest. We are very rarely we will have 100% owned subsidiary because ACCI examiner is never generous. So he always gives very tough ones. He doesn't give the easier ones. SIMA sometimes goes on the full control without a non-controlling, but not ACC at all. So we will always have a non-controlling interest. So non-controlling interest, as I said, is considered to be the shareholders of the group, but there is reflected with equity. They are considered to be the shareholders. So that is why we said yesterday, we show the parent company share capital, we show the consolidated retained earnings, all that as equity of the parent. And then we add the NCI part, and that is what we call total equity. So this is what is even explained, is reflected with equity. So whenever we have to calculate ratios, we will take total equity, including the NCI figure. That is what we call total equity. So goodwill, when calculating the goodwill at the acquisition, value is NCI is added. So the consideration plus the NCI against the net assets value, the fair value of net assets is compared, and that's how we get the goodwill. That's what we learn. Now, this is what I want you to look at, the second line. IFRS 3 business combinations allow two methods to be used to value the NCI at the date of acquisition. One we call fair value, other one we call proportion of assets. Now remember the company that we were buying, right? Company A was buying company B, say they bought it on 1/1/14 or something like that. At that time, the fair value of all the assets were 80,000. Net assets were 80,000. So if you are applying the proportion of net assets, is having a 60% control. If you are applying the proportion of net assets, the NCI value is of the 80, 40%, 32,000. Right? NCI value is of the 80, 40%, 32,000 is the NCI. That is if the examiner says proportion method is applied. So let's assume that we are going to apply the proportion method. Let's assume the consideration that we are paying is 120. NCI at proportion method is 80,000, 40%, 32,000. 52,000. Let's assume the total assets of this company is 80,000. 72,000 is the goodwill. Now I want you to remember one more thing here at this moment. This is another very important thing I'm teaching you. This 72,000 goodwill, if proportion method is applied, this 72,000 goodwill only belongs to the parent. Only belongs to the parent. So therefore, you remember I told you 3 adjustments for post-acquisition profits? Goodwill impairment, excess depreciation, and unrealized profit subsidy selling to the parent. Now, if the goodwill is applied on, if the NCI is applied on proportion method, the goodwill is only the parent's goodwill. And therefore, no impairment should be charged to the subsidiary profits. So out of the 3 adjustment, one will go off if the goodwill, if the NCI is measured on proportion method. Is it clear for you?
Yes, yeah.
That is a very important adjustment. I want you to know that you have to read carefully the examiner's question. If the examiner says proportion method NCI, then the goodwill belongs only to the parent. The goodwill that is appearing in the consolidated balance sheet belongs only to the parent, and therefore the impairment also should be entirely charged to the parent. Nothing should be adjusted from the NCI, and therefore the NCI profit should never, the subsidiary profit should never be deducted by that goodwill impairment.
Okay.
If the fair value method is applied, examiner might say goodwill is valued on fair value. Fair value means the examiner will tell you the fair value of the goodwill or the NCI on the date of acquisition. So they might say the fair value of the goodwill on the day of the acquisition, and on the goodwill fair value on the day of acquisition, the NCI is 40,000. So we pay 120. We buy the NCI, or rather we have an NCI of 40,000 fair value. $60,000. The net assets value is 80,000. Now the goodwill is 80,000. Now this goodwill belongs to the parent and the subsidiary. Parent and the NCI, parent and NCI. This goodwill, if the fair value method is applied, the goodwill that is appearing in the consolidated balance sheet is for both parent and the NCI. In that case, any impairment also, both parent and NCI must bear up. If you own the goodwill, impairment also comes for you. So therefore, in that situation, the 3 adjustments will come. So if the NCI is valued on fair value method, if there's impairment from the post-acquisition profits, we must deduct the impairment, we must deduct the excess depreciation, we must deduct the unrealized profit subsidiary selling to the parent. All 3 adjustments will come. But if it is proportion method, goodwill impairment will not come. This is the key thing you need to learn.
Yes, and quite often the fair value will come up in exams.
Normally nowadays, most it is fair value. Now it is mostly fair value. Earlier they were giving the other one, but now we see most of the time they give the fair value. So it's generally the fair value that comes up in most of the time. Right?
But they do like to catch students out, so.
Yes. I know they are, they generally try to sort of confuse the student as much as possible.
Yes.
You know, they have a different way, and the question itself is so lengthy. By reading the question, by trying to understand, your brain 50% is completely gone.
Yes, yes.
Now,
And yeah.
I like
And
the SIMA
I
model
think
now. Now, SIMA model is very short questions. Your brain is not getting taxed so much in the reading
no.
portion.
Yeah.
Anyway, both has its own advantages, disadvantages. So it's all right. So this is something which I want you to look at. So IFRS 3 permits group to choose how to value NCI on an acquisition. Thus, it is possible for a group to apply the fair value method for some subsidiaries and the proportion. Now, this is a very, very important last sentence I have put it up. Now, you might have couple of subsidiaries. You might have a couple of subsidiaries. You might have company A, parent, holding subsidiary B, holding subsidiary C, holding subsidiary D. So these are what we are going to look at later on, what we call the complex structures. But for the moment, let's assume there are 3 subsidiaries. Now, IFRS 3 permits the group to decide how to value NCI. So they might decide, as far as B is concerned, they will go with the fair value. As far as C is concerned, they can go with the proportion. As far as D is concerned, they can go with the proportion. So it's all right. 3 subsidiaries, they can have 2 methods, both methods working.
Okay.
But once they decide on B, the fair value, every year it has to be the fair value. This year it can't be fair value, next year proportion, no. Once they decide for C, proportion method, every year it has to be the proportion method. So that's another thing ACC examiner will be testing you on theory. He might put up a question and ask the 3 subsidiaries are there, and the directors are thinking of changing from fair value to this thing, whether it is permissible. It's not permissible
Yes.
according to IFRS 3. You can, you permissible to have the 2 methods for 2 subsidiaries. If you are going to change it, it's going to be a change of accounting policy. Then in that case, you have to disclose it and you have to restate your old figures because with the change coming up. This consolidation, all that. Too much of complication. Fair value may be calculated using the market value. So sometimes the fair value the examiner might give you, or otherwise sometimes they might give you the subsidiary. If it's a listed company, Fiona, say a subsidiary may have 2 million shares. Examiner giving you the fair values, they might say there are 2 million shares. The market value of share on the day of acquisition is $6. They will say the parent is acquiring 60%. So that means the NCI is 40%, which is 800,000 shares. Yeah. And the fair value will be 800,000 into 6, 0.8 million. So that's another thing that they might say. Without giving you the fair value, they might give you the market value of the subsidiary somebody shares, and then you have to calculate again. ACC examiner do this kind of a thing. So normally in P2, we are told the fair value of NCI or the subsidiary share price will be given, so we can calculate the NCI all the time. Proportion of net assessment. So this is what we were talking the other one. Under this method, NCI is measured by calculating the share of the fair value of the subsidiaries net assets at the time of acquisition. So 80 million or 70 million or whatever the figure, 40% of that is our proportion. Originally, we had only old method, the proportion method. Now only they have brought the new method. Impairment of goodwill. IFRS require goodwill tested at each year reporting date for impairment. This means goodwill will be reviewed every year. that it has the fair value not overstated in the consolidation. If an impairment loss exists, goodwill is written down and the loss is charged to the P&L statement. So when impairment is there, if the NCI is on full value or the fair value method, the goodwill impairment will be against the subsidiary profit. If the NCI is on proportion method, then the goodwill impairment will be straight charged to the P&L of the parent. So this charge against the profit will result in a reduction in equity section of the consolidated statement of financial position. How the impairment loss is charged against equity will depend on the method adopted for valuing NCI. Fair value method, valuing NCI implies recognizing goodwill in full. So the moment the fair value method comes, goodwill belongs to the parent and the subsidiary, or parent and NCI, and therefore any impairment should be charged to both the parent and NCI. And to record the impairment, reduce the goodwill by the full amount, reduce NCI, reduce consolidated retained earnings. That is what we do by charging it to the subsidiary P&L. Such method, goodwill is only the parent goodwill that is there, and therefore any impairment should be charged to the parent in the consolidated statement. Record the impairment, reduce goodwill, reduce consolidated earnings of the parent. That's all. So remember, we have, when you are preparing the financial statements, the P&L, profit or loss statement, we have, so remember this terminology is also very important. Earlier during our time, we called profit and loss statement. Now we are calling statement of profit or loss. You know, you might lose 1 mark if you just go and write profit or loss statement. Profit and loss statement. It is now called not even profit or loss statement. It is called statement of profit or loss. Statement of financial position. Statement of cash flow. The term statement comes before the description. So good to know these little things, because all these little things carry extra 1 mark, half a mark, which can make the difference between your pass and the failure. So we have 2 sections in our profit or loss. The normal transactions that happens with all the realized profit, we show starting with revenue, cost of sales, then gross profit, then establishment expenses, administration expenses, selling and distribution expenses. Then we arrive at what we call profit before interest and tax, or what we call operating profit. And from there we deduct the finance charges. Now we don't call interest, we call it finance charges. We deduct finance charges and we arrive at profit before tax. After profit before tax, we put the income tax, and then we arrive at profit after tax. Then we add what we call other comprehensive income. Other comprehensive income. They are almost all are unrealized gains or losses. Example, the losses or gains arising from the exchange translations, we put it under there, other comprehensive income. Any revaluations that comes up, it will be put it under other comprehensive income. So all those things are put under the bottom part of the P&L, and that after that, the profit after tax plus other comprehensive income, we call it total comprehensive income. Profit after tax plus the other comprehensive income, we call it total comprehensive income. So remember yesterday we discussed that the profit after tax, we must split it between the parent and the subsidiary. Again, I'm reminding you, so only the subsidiary part, we will give it to the NCI. So when you come to that point, there are 2 splitting happening here. One at the profit after tax. The profit after tax should be split between parent and the NCI. Then the total comprehensive income, including the OCI, again must be split between the parent and the NCI. So there again, that OCI part, only the subsidiary OCI part, you will split between the NCI and the parent. So we will look at some questions when we do, but you have to remember that one.
Yeah, okay. Yeah. And in fact, the first time I failed this paper,
Mm-hmm.
the question was on a profit and loss accounts
Yeah.
and other comprehensive income. And when I'd been revising,
Mm-hmm.
I'd been looking at balance sheets
Yeah. Mm.
and cash flows, and it completely threw me
Yeah.
that because they hadn't really examined profit and loss accounts, and it
Yeah.
completely threw
Yeah.
me.
Yeah.
And I hadn't really looked at that area, so I
Yeah.
know that you have to cover all bases really as
Yeah.
much as possible.
Correct, correct. Because you need to know all three because he can put up anything because the consolidated statement of financial position is the most common one. But having said
Yes.
command, this man changes and put it to the profit or loss. And sometimes it is a cash flow statement. And sometimes it can be
Yes.
even a little section on the statement of changes in equity. That's another complicated statement for us, the
Yes.
consolidated statement of changes in equity. And I see 15 marks on that question most of the time in our ACCA paper.
Yeah.
So we need to look at all these. So actually, I'm covering up all that, don't worry. It incorporates two statements. One, the statement of profit or loss, which is up to the profit after tax, and the statement of other comprehensive income. Both these together, we call it total comprehensive income. Now we are coming to another very important area. All this time we were talking, we are preparing financial statements as at 31st December 2016, but we have acquired the company long before, maybe 2014 or something like that. But it may so happen that our acquisition or the full control, when I say full control, it's not the 100%, I'm talking about the 50% plus, we take it only halfway through the year. We are into the 31st December 2016 year, 3 months to the year, somewhere in March, end of March or 1st April, we go and take over a company. So the consolidation starts from that day. Consolidation starts from that day, that is from 1st of April. So this is a
Yeah.
very, very important adjustment for the P&L, for the profit or loss. Profit or loss, first 3 months, no split in. First 3 months revenue we don't take at all if it is happening at the third month. The 9 months revenue of the subsidiary we will add it up. 9 months expenditure we will add it up. 9 months taxes
Yeah.
we will add it up. So whenever we have something happening, we have to remember up to that point, whatever the profit they have made, it is pre-acquisition, and after the thing, it is post-acquisition. So P&L will be proportionately taken for first 3 months, second 9 months, or first 6 months, second 6 months, pre and post, right?
Yeah.
But statement of financial position, no proportion, because we are preparing the statement of financial position not for a particular period. Statement of financial position is always, remember, for a particular day. So this is another very important
Yes.
thing when you put in the headings. The consolidated statement of profit or loss for the year ended 31st December 2016. Consolidated statement of cash flow for the year ended 31st December 2016. Consolidated statement of changes in equity for the year ended 31st December 2016. Consolidated statement of financial position as at 31st December 2016.
Yeah.
The only statement what we prepare as at is the statement of financial position. So statement of financial position, we don't take 9 months and 3 months because now it's a subsidiary. So we prepare on the day of the consolidation, we add all the assets, we add all the liabilities, and we prepare in the normal way, no proportion.
Yeah.
So that's a very another important thing. If you're all
Yeah.
right with the balance sheet, I think maybe in the P&L, you might find little few things. Unless otherwise it is told, normal to assume that the results accrue evenly and it should be time apportioned. So that's a normal CIMA examiner. CIMA examiner gives 12 months revenue, 12 million, and they will say it is accruing on a timely basis. So we know second 9 months we have to add 9 million to consolidated revenue of the parent. If the consolidated revenue of the parent for the whole year is 50 million, we will add 9 million and make it 59 million revenue. But I seen again our ACCA examiner, not necessarily he will go on evenly accrual basis. He might say 60% 60% of the sales happen during first 6 months, 40% of the sales happen during the last 6 months. So 12 million, then we have to split 7.2 and 4.8, and then we have to look at, okay, last 6 months 4.8, first 6 months 7.2, then if you are going to take another 3 months out of the 7.2, another 3.6 will have come up, and we have to make proportions like that and work it out. That can be another bit of a complicated calculation. So long as you know the basics, so long as you know the fundamentals, you can always work around the examiner rather than trying to get trapped into the formulas.
Yeah.
Now, intergroup investment. So when the parent has invested in the subsidiary being a separate entity, it's controlled by the parent. You remember we discussed, and the parent will appoint the directors, majority directors. So the parent can decide to pay a dividend out of the subsidiary. And when a subsidiary pays a dividend, let's assume the subsidiary makes a dividend of 10 million. When the 10 million is paid, 60% of the 10 million will come to the parent. When the parent is holding 60%, the balance 4 million will go to the NCI. So, when the parent gets a 6 million, in parent company's books, what is the entry? They will debit cash and credit dividend income, isn't it? They will debit cash and credit dividend income, which is the right entry, because as a separate entity, that is what they should do. But when you prepare the consolidated financial statements, it is coming from your sister company, intercompany, and therefore that dividend received 6 million cannot appear in your consolidated statements. Right? Remember, dividends are paid out after profit after tax. Yeah. So in the subsidiary books, you might not find any dividend. I mean, not in the books, in the financial statements, you might not find any dividends because they generally give it up to the profit after tax. But in the notes, they will say the parent, the subsidiary declared a dividend of 10 million, and we know immediately in our income we will have a 6 million of it, and we have to take it. Now again, a little another complication that come up is during a mid-year acquisition, Fiona, right? The company may be acquired in March 2016, and the examiner might say the dividend was paid in June 2016. In that case, no proportion. Dividends don't arise on proportion. In June 2016, if they are declared a dividend, that dividend will appear in the parent company books as a dividend income. Cancel that off. Remove it. But if the subsidiary has declared a dividend before the acquisition, right, before we took over the company, if they have declared a dividend in February 2016, then surely in our books we don't have a dividend because we did not receive a dividend because I was not the parent at that time. And therefore there is no elimination. There is no elimination. So if the examiner says the dividend was declared in February, if you go and reduce your parent company dividend income by 6 million, you are wrong. Because the parent did not receive a dividend because I was not a parent at that time. So you have to be careful of these adjustments, these dates very carefully. Although I'm saying all these things, I know it's not very easy in the exam to keep everything in head, but this is why I'm talking all these things in very simple without even going into the numbers and the questions so that you can get your head cleared of all these things without going into big numbers and complications. Because when I go into the numbers and complications, your head will get more heated. So it's good to have good to have cold weather these days for you. So it will get heated very soon, and so it is good for us to get it just out of our sight, all these things, without even looking at the number.
Yeah.
Non-controlling interest in profit or loss. This is what I have been talking about. Profit for the year and TCI. So there are two items, profit after tax and the total comprehensive income, are analyzed between the amounts attributable to the owners of parent and the amounts attributable to the NCI. Analysis is presented at the bottom of the statement. So once you prepare the statement, you have to split that. You arrive at the total profit and you have to split that profit between the parent and the computed at the balancing figure. So this is what we were looking yesterday. Let's assume the profit after tax 100 million after adding total revenue, total expenditure, all that. The consolidated profit after tax is 100 million. But our workings in the subsidiary, we would have shown a profit of salary, say 40 million. And the goodwill was, shall we say, goodwill was measured on fair value method. So there was a goodwill impairment of 3 million. Sorry, NCI was measured on fair value method. If the NCI is on fair value method, goodwill impairment should be removed from the subsidiary profit position, 3 million. Let's assume the subsidiary is sold to the parent and the unrealized profit was another 2 million. Remove that one. Let's assume at the time of acquisition, there was a fair value adjustment and there was excess asset of 10 million, and now 2 years have gone and the life period of the asset at that time was 5 years. So 2 million, 2 million, 4 million is gone. So it just acquisition profits 40 minus 3 minus 2 minus 4, 5, 9, 31 million. 31 million. Now what we do is this profit, this is the only profit, we try to split it. So this subsidiary adjusted profit 31 million. Let's assume our subsidiary is 40%. So 40% of 31 is going to be 3.1, 6.2, 12.4. What we do is this profit after tax of 100 million, we put it up, we split it. How do we split it? We know profit attributable to NCI $12.4. Total profit 100. The balancing figure is the parent company share. 87.6 is profit attributable to owners of the parent or the equity holders of the parent. So this is how we calculate the profit splitting. We look at the subsidiary profit, and after the three adjustments, we take the profit and we do the NCI part. And then the balancing part, 100 minus 12.4, is the way we show it. Because if we take the parent and do it, it's a very complicated one. We don't do like that. It's easy to take the subsidiary profit. After three adjustments, take the profit, give the NCI share, and the balancing entire figure is the parent company profit. So this is the important adjustment. What we do. So that is the balancing figure. That's how we calculate it. Goodwill impairment, as I said, if the fair value method is employed for NCI, it should be reflected. The goodwill impairment belongs to the NCI also. If the proportion method is implemented, goodwill impairment will not happen to the parent, and goodwill not happen to the NCI. Media acquisitions, financial position should never be time apportioned. Slides are very important. You can read these slides. I will share these slides with you. It should never be time apportioned. It should never be time. But you have to time apportion the reserves because you have to look at up to which point the post-acquisition, pre-acquisition. So you have to time apportion the reserves, but not the assets and the liability. Intergroup balances should be eliminated in full because we treat it as a single entity and therefore no intercompany balances can creep in. Any profit still held within the group, what we call unrealized, provision for unrealized profit adjustment need to be done. Another item may be the transit. You have sold some goods to me, and when you are the parent, when you sell, you will credit your sales and debit your receivables. I have still not received the goods. When I have not received the goods, I will not show it as purchases, neither I will show it as payable. So my balance, receivable balance, my payable balance and your receivable balance will not balance. The reason, there is some goods in transit. So we have to balance it with that goods in transit. So that's another figure that we will be looking at. That's one way. Other one is the cash in transit. I have sent you some money in settlement of my liability. I have credited my cash book, debited my payable, so I show a less amount, but you have not received the money. So that is what we call cash in transit. So that one we will have to adjust it. So there is a little slide I have given. Receivables, the higher amount, with the amount in transit with the lower amount. Goods in transit, receivables, higher amount, inventory, payables with the lower amount. So when we are looking questions we will look at, because these are surely the type of things what we will get always. Inventory. Any provision for unrealized should be adjusted if the subsidiary sells to parent. If the subsidiary sells to the parent, the inventory of the subsidiary is overstated and therefore inventory should be reduced. Any PUP should deal with when the parent company retains if the parent sells to the subsidiary. Cost of sales and sales should be adjusted whenever there is intercompany sales. With that, we have basically completed the main bulk item of our consolidation. Right? I can, tomorrow when we meet, we can do two things. We can go and look at more of the complex structures and advanced calculations, or we can look at some questions. Whatever you want it, I can do it.
Okay, sorry, the sound went a bit slightly then when you were speaking. So we can look at questions, or I didn't quite hear what the other thing you said was.
We can either look at the start with the questions tomorrow, or otherwise we can look at more onto the theory on the complex group structures like verticals and the horizontals and all that. Look at a little bit more theory and start on the questions after that. Whatever the way you want, I can do it.
Let's try looking at a few questions tomorrow, and then because we've got a session Friday as well.
Yeah,
and then
that's right. We have a Friday session.
Add a bit more to it on Friday session. Yes, that would be good.
Okay, right. So tomorrow we will look at some questions. I will send you the questions in advance, and we will try to look at some of the smaller questions, and try to get an idea, kind of ACCA questions.
Yes. Okay, that'd be brilliant. Thank you.
Right. So tomorrow I will see you at the same time with some questions.
Okay.
Okay,
then, thank you.
Have a great day. Thank you. Take care.
You too. Thanks very much.
Bye. Bye.